So, good afternoon, everybody. I hope you can hear me loud and clear. This is Hardy Mir speaking from Basler, and I warmly welcome you to our first half-year conference call. I'm proud and happy to present great results today in these crazy times. And I would like to start with an executive summary. You see the agenda here on slide 2, then followed by financials, quick review in point 3 regarding the share, and then finally giving you an outlook for the remainder of the year and also our midterm outlook. And then I'm sure we have enough time for a Q&A session today. Let me give you a brief summary regarding the COVID-19 impact on slide 3. We at Basler had highest priority on our employees' health, and this was very successful. Still, we have no infection within the Basler team as of today, worldwide, and the Basler team did a great job in, let's say, taking this challenge and is very highly motivated in this situation. The organization has been able to continue all operations and successfully service the customer with rapid adjustments of shift models and production processes, as well as immediate transfer to home office. And the majority of our employees are still working from home and slowly coming back to the office under the common rules that the society has today. We also prepared the company for a potential second row effect, so for a potential change in the situation. We have scenario plans in place. We already initiated cost-saving programs. We drew open innovation loans from KfW where we had already permissions on. And finally, also we adjusted our dividend payout ratio to 20%. We successfully managed all corona difficulties, and we are, let's say, well prepared for the future. Let's review the market environment and the performance of Basler on slide 4. The market condition was pretty ambiguous over the course of the first half year 2020. Overall, the German machine building industry declined. Bookings were down 8% and billings were down 5%. So especially the automotive industry and the general machinery industry was highly affected by COVID-19. We saw good business for capex goods and semicon electronics, so there was clearly kind of an upcycle happening, and we see continuing growth in medical and logistics applications. Our performance compared to the market, bookings up 10%, billings up 9%, and all pure organic. So we doubled our earnings after tax due to these high sales, high gross margins, and economies of scale that we could leverage. Especially our regional and vertical diversification or vertical market diversification helped to grow our business against competition. And the two production sites and mostly independent supply chains supported our competitiveness as well. We were pretty honored or happy with the Axia Best Management Companies Award in the second quarter of this year. So besides all COVID challenges, we continued our our innovative course and launched multiple new products in the first half of this year, as you can see on slide 5. We started the series production of our Ace 2 mainstream cameras with basic and pro versions. We released a new powerful software development kit of Pylon, the release 6.1. We upgraded the Med Ace line with dust protection. We start series production with our Boost camera and the bundle together with frame grabbers, which also show the strategic direction we are going. And we also introduced 2 new connections to processor families in the embedded world. It's the processor families of NXP and also the NVIDIA Jetson platform. Finally, we also expanded a lot of our companion product lines, so additional lenses, lighting, cables, and also quite some tools on the website to configure and find the right product for the customer. These expansions of our product line supports us to win further market shares in the cameras business inside and outside factory applications, and also transitions us further from a pure play camera company to a full range provider. On the next slide, the organization, that's slide 6, the organization and the functional breakdown is highlighted. There were no significant changes in our organization over the course of the last 6 months. We had some hires, but the overall staff number kept the same. Also, the structure kept the same, with approximately 36% in sales and marketing, 25% in production, 15% of our employees in admin, and 24% in R&D. We had no reduction of work time due to COVID-19, so we were working full throttle with a very highly motivated organization. It has been really a pleasure for us to see how motivated and flexible the team has been and how we together weathered the first wave of the Corona storm. In the coming chapter, that's the financial chapter starting on slide 8 actually, I would like to invite you now to have a deeper look into the numbers of the first 6 months of 2020. Starting with the development of the bookings and billings on slide 8, you can clearly see the strong bookings development over the course of Q4 and Q1. So namely here the 44 million in Q4 and the 53 million in bookings in Q1 this year. But you can also realize the slowdown in the bookings in the second quarter of this year. Bookings have started to decline because of seasonality effects in semicon electronics. So the main wave in this year's semicon and electronics business is over for us. And now the machine builders are starting to build their machines and start to install the machines in the factories. And what we also see now is the impact of Corona or of COVID-19 in the automotive and general machinery industry and automation industry. Billings remained on a high level in Q2, and we will later talk about the outlook for the coming months. But billings, as you can see, are still very strong, or have been strong here, 44 million Q1, 45 million in Q2. With regard to the regional breakdown, you can see this on slide 9. We were profiting from the quicker COVID-19 recovery in China. However, this also led to a situation where we had even more shifts of our business towards Asia. As you can see, for the first 6 months of this year, 54% of our revenue has been realized in Asia. 29% in Europe, or mainly in Europe, so EMEA region, and 17% in the Americas. As you can see on the next slide, that's page 10, we also made significant improvements with our gross profit margin. So Q1 here 52.6%, Q2 53.5%. We had no extraordinary M&A effects compared to the first half of last year, and we were also profiting from lower direct material costs because of our bargaining power and improvements, and also because of the economies of scale in production. The combination of higher sales and better gross margin led to a significant increase of our gross profit by approximately 3 million per quarter. As you can see here, we were coming, let's say last year, Q1, Q2, from a level of around 20 to 21 million, and we are now at 23 to 24 million. So the company is from a gross profit perspective at a different point at the moment, or has been at a different point in the first 6 months. On the following slide, you can see the leverage on the earnings. So the higher gross profit also more or less fully led to a higher earnings. So also the earnings went up compared to the first half of last year of approximately 3 million per quarter, because the organizational size has not been significantly enlarged, and also we were able to reduce our other OPEX costs due to lower travel and due to lower expenses on, for example, for shows. So there were on the other cost side a lower level in the first 6 months of 2020. All in all, the earnings before tax margin in the first half of this year is above 14%, so for us at a very high level. The coming page, slide 12, is summarizing the first 6 months and is comparing it to the first 6 months of 2019, and I will quickly go through the different numbers. We talked already about the order entry, so 92.3, 10% plus. Sales, 88.9, 9% plus. Gross profit margin, 53.1%, so 3.7 percent points better compared to first half year 2019. EBITDA 19.8, so a plus of 45%. EBIT 13.2, so 76% better. Earnings before tax 12.8 million, so 78% better. And net income, as mentioned in the intro, doubled with 9.6 million euro. Earnings per share also roughly at the same point like the net income, as from an increased standpoint. There is a little bit of a shift due to different number of treasury shares. But earnings per share first half year, 96 cents. Let's come to the cash flow on the next slide. This is slide 13. So you can see that over the course of Q1 and then Q2, the free cash flow went up. We were still on the negative side in Q1 due to increase of working capital. And then in Q2, we ended the Q2 with a cash flow of 3.7 within Q2, 3.7 million. I have to say that also in Q2 2020, we had extraordinary M&A payments for our M&A transaction in China. This was the final payment. So, and as we are not openly talking about the overall payment for the China deal, but what you can see that this final, a normal investment cash flow is in the range of 4 to 5 million, and then you can also make your own math where we would have been without this extraordinary effect. So also here the cash flow, the free cash flow is pretty sound, taking into account this extraordinary payment and also taking into account that we increased the working capital due to higher sales in the first half of this year, and then in the third quarter, if revenues are stabilizing or declining, then also there is a positive cash flow effect happening. This is also the normal seasonality of our cash flow statements. Coming to the summary of the cash flow and liquidity on slide 14. We started the period, the first half year, with cash of 35.2 million. Cash flow from operations have been plus 15.4. Cash flow from investments 13.6, including the extraordinary payment or effect from the payment of the China transaction, the final payment. Free cash flow in total then 1.8 million, and cash flow from financing 1 million. And doing the math, we ended up the period with 37.9 million euro on our cash account. So we have a sound cash flow of, or a cash account for whatever COVID will bring us into the future. Looking at the net cash, because also we increased our debts a bit. As mentioned earlier, we pulled in certain innovation loans. So the loans increased to 24.9 bank liabilities. And then if we compare this to our cash account, the operative net cash is 13 million in total. So I'm closing this chapter, coming to the quick review of the share performance in the first half year on slide 16. I mean, this chart is not a real surprise. We were also suffering from the COVID macro effect by mid of this period, and then step by step coming back. First a little bit slower than the tech DAX, but finally also we were able to beat the tech DAX development over the longer run here. And we are happy about the trust of our shareholders in such times. So we ended the period with a market cap of 582 million euro. I mentioned also earlier, that is here in more detail shown on slide 17, that we decided to lower our dividend payout ratio for the year 2019 due to the uncertainties of COVID-19. We lowered it from normally 30% to 20%. So we paid out 26% for the year 2019 per share. And the feedback we got from our investment is there was a lot of understanding why and how we did this. So now I'm coming already to my last section here, the outlook, starting on page 19. So overall, I can summarize that we experience a surprisingly strong demand in the first half of 2020, taking into account the corona situation, and also taking into account what we can see, that some of our competitors, how they are doing at the moment, because they are not having the diversification with regard to regions and industries. However, for the second half of the year, we watch closely the potential second row effects of COVID-19 for our industries, and the situation is clearly uncertain and the visibility is pretty low. For the second half of 2020, we expect that the demand from semicon electronics that we have seen in the first half will decline, and will also sharply decline due to seasonality effect. So it's not due to corona, it's due to seasonality effects. Automotive capex markets and also the general automation / machine building industries will, from our point of view, remain weak. I mean, we still see that the recent numbers from for example, the Machine Building Industry Association, VDMA, the average bookings of German machine builders for the first half year is down by 19%, and it takes some time until the order books turn into revenue. So definitely we believe that there will be at least the first months of the second half, we will still see a very weak business in these areas. For medical and logistics, we believe customer will continue to grow. We also see double-digit growth in our books, but it's on a relatively low level, so this is why it doesn't lift the overall top line too much. We definitely also see increasing uncertainties coming out from the China-US conflict, especially for semicon electronics businesses, and we need to watch this closely. And last but not least, the recent strong euro gives us quite some headwind on the currency side, because we have a higher, let's say, inflow of US dollar and Chinese RMB than we have spendings. Based on the positive first half year results and with many uncertainties in front of us, our annual guidance is stated on page 20, and the annual guidance we give out is revenues between 155 and 165 million euro and earnings before tax margin between 8 to 10%. We stick with our midterm guidance on page 21. Nothing has changed. We want to increase the revenue for the company by 2023 to 250 million, and also our guiding line for the earnings before tax margin stays at 12%. This means for us roughly a compound annual growth rate of 15%, and this also means that we believe that the main drivers of the vision industry is intact. The trend towards more vision, especially in out of factory, but also the trends in the longer run towards more automation and industry IoT is absolutely intact, and we want to gain from this. And this is also why we keep our foot on the gas pedal regarding investments we do in marketing and sales and in R&D. Having this said, I'm coming to the end of my presentation. I thank you for your attention, and I open the floor for our Q&A session.